Okay, traders, we are going to cover in this section a component of your trading that is absolutely essential. Absolutely essential to your ability to profiting in the market. And the first thing that I want to say is this, that you don't have to know what direction the market is going to go in the near future in order for you to be right in your trade or in order for you to be profitable. Because what traders like to do is they'll do their little analysis and then they may talk to their friends and they'll say, well, I think euro is going up. I think British pound is going down. The yen is, the yen has a ways to go. And they have all of these opinions on what they think is going to happen in the market. And certainly we all have our opinions and our biases and our preferences and what we'd like to see happen. And our bias may simply be weighed on positions that we're holding at the time or positions that we want to take. Now, remember, we have to remain completely unbiased and objective in our trading. And we can certainly speculate on what the market is going to do in the short, medium, and long term future. But when it comes to trading, we can refine our entry to such a degree that we can take an entry, take some profit out, and the market can still go in the direction opposite to what we thought it would in the short term. And I'm going to show you how that is done through our trade entry and trade management sections of this course. Now, what we're looking at this chart is we're looking at a British pound 60-minute chart, and we have prices gone in this consolidation, and now we've moved into this uptrend here, and we've got this trend line here on the most recent upswing, and we have the little bit of a medium-term trend line happening. Price has rallied, and let's just look to see where this rally is exactly. And if we look back in time, we will see that there is a very important level of support here just below 85.50. And let's look back a little bit further. We'll take our Fibonacci's and we'll draw them from this high down to this low. And we will also see that price is at a, just trying to fix these perfect here. You see this downswing, price has fallen, it has retraced, and it has tested the 38% retracement and this level of support. It has retraced and come back and tested the level again, and it's laboring to get above. So if you look at this high relative to this high, price is really struggling to try to get above this level now. We've got our 10-day moving average, and as we can see overall, just taking this big picture, or just take this whole scenario right here. Take this scenario right here and look at how the market is struggling to get above this level. Therefore, we would conclude that there is a strong potential or a higher probability that market may turn at this point. Now, let's just expand it again, knowing that this level here at 85, say 85.40-ish is an important level. Now let's refine it even further. Price has now come down to the last level of support, forming a neckline here. Now that we've formed a level of support, we're looking at a potential reversal. First of all, this is a false break reversal. Okay? We've got our false breakout here. We've defined a level of support and resistance right through here. And that level of support and resistance happens to fall at around the 62% retracement to 79 retracement, somewhere in this area. So price may come back up and even you see this 85.20 level. Price may come back up and test this level from this low right here to confirm the potential reversal. Let's take this down now to a 15-minute chart. Price has rallied. Price has rallied to 85.60 and has been rejected. It's rejected this previous day's high. We know that 85.50 area is a key level of support and resistance has been established. Let's look at our 4-hour chart now. Here's our 4-hour chart. You see this high, price rallies, price falls, it rallies, and it's struggling to get through that key level at 85.50 here. Struggling to get through. Back to our 15-minute chart. Back just another quick look at our 1-hour chart. Let's watch price retrace. As we are now in the Asian session, watching price retrace, bouncing at the 50% level. Now it comes up to our 62% retracement level. Let's go down to our 15-minute chart to see what that looks like. This is our swing down. Now we are starting to retrace. This is our 85.50 level here. Now price is retracing. Here we see it in a more defined manner. And this is what we see right now on the 1-hour chart. Now, trade entry. You see how price, we have a level here that we have established as important. You see the lows of this range right here, this choppy range. Price breaks below, establishes a base for a head and shoulders. Now it rallies up, and you see how the market is moving in this range. This candlestick moves from a low of 16 to a high of 25, so it's 10 pips. 10 pips is a lot. And if we are going to use this 62% retracement as our entry level, you want to make the trade as the candlestick is moving up, okay, up against the direction that you want to trade, because you want it to go down. Because if price remains in this consolidation, then as it remains in this consolidation, you want to stay, you want to immediately move into the positive side of the dealing spread. And even if it just moves down from here, from 85.25 to 8,500 or just below, you've already got your first profit even before it gets to the low. So you see how much room you have in the last range. We need to know that we've got enough room in this range to take some profit, because the market may continue to go up. Therefore, if you get a good entry right here, right in this bold-faced candle, so you have to realize that as price is ticking up against the direction that you want to make the trade, you need to sell into upticks. And that will, of course, make your stop tighter, because it'll be closer to above where your stop level would be, which is above this 79% retracement or above the high. Think about it. If you sell this right here at 85.25 and your 79% retracement is at 40, you can afford a 25 pip stop easily a 25 pip stop on this trade, and it gives you plenty of room for the market to move down 20 to 25 pips before you make your entry. Well, let's watch. If you trade it at 25, you're already up 10 pips minus spread. You've already covered the dealing spread as price forms its level of resistance here. It's forming a level of resistance right here. Now it's driving you a little bit crazy, but you're still dealing primarily on the positive side of the dealing spread, and then it falls and boom, you've got first profit already. Now, price can move and continue to rally, and this head and shoulders may not hold at all. But remember how important, how powerful this key level is. That is what's going to drive price in your direction. You just have to find the technicals based on what you've learned here. Find the technical areas that you believe is a wide and prudent and high probability area to trade. Now look at this. You're already profitable. Right here on this break of 8,500, you've got 25 to 30 pips already. Even if price comes all the way back and tests. If you chase it right here, price could move right against you and stop you out. Where are you going to put your stop? How far is your stop going to be away? Because it can come against you very easily. In this case, it doesn't. It keeps going down to, this is 162% extension. Now let's look at let's have a look to see what it looks like on the 1 hour chart. Price comes up, tests the 62 and the level of support and resistance, tweezer. So if you're scrolling from one chart to the other, don't just be fixated on your 15-minute chart. Yes, the 15-minute and the 5-minute charts are good for entry, but don't fixate yourself on them. Now look, you're scrolling to your 1 hour chart and look what pattern appears. You've got a beautiful tweezer bottom at a very commonsensical level, and the force of this level of resistance, we've already got a confirmation that price is moving down here. If you didn't trade there, here's your second chance. You could have traded here, profited. Now the market gives you even a second chance. Look at the tweezers, right? Now look what happens. Well, now the neckline's exposed to a retest. And we come all the way back to this last level of support, becomes resistance, and then boom, price falls again to 83.60. Your entry was 85, 20, 25. Now you're already down to 83, 8,400, 125 pips just coasting. And of course, you're going to take first profit before the base level of support. Manage your stops accordingly. You can leave a percentage of your stop. Let's say you take 70% out before support at 25 to 30 pips. You take 20% out on the next leg down, here or here. You leave 10% in case price decides to keep moving down. Okay? We're in this is what we call a bear flag. We've got this bear flag formation setting up before our next leg down. If you have 10% of your position still in the market, we entered at 85.25. Now we're down at 8,200. You're up 325 pips right now if you've managed your trade effectively. But the idea is right here, if price is moving up and you enter on an upticks or an up moving candle, bold-faced bullish candle, and you sell into it, you are in a much higher probability situation to help to manage your immediate and current situation with the trade. Move to the positive side of the dealing spread. You'll be closer to your stop and closer to your first profit level.